Hi, everyone. We are now going to look at this question, which is from May 2019. Now, this question is, of 8 marks. It was tested in the examination during that attempt. Okay, it's question number 4A from that examination. The question suggests that Deepak Limited, an automobile group, acquires 25% of the voting ordinary shares of Sean Limited, another automobile business, by paying 4320 crores on 1st of April 2017. Deepak Limited accounts its investment in Sean Limited using equity method as prescribed under Ind AS 28. Now, this is where we, of course, expect it to be. So there's a 25% investment, which makes it an associate investment, right? And of course, the equity method would have been applicable. So that confirms our understanding. Okay. Now, this is done on 1st of April 2017. Always, when you look at a consolidation question, look at the dates very carefully. Remember those dates, highlight them in the examination if need arises. Okay. At 31st of March 2018, now this is 1 year later. Okay. Deepak Limited recognized its share of net assets changes of Sean Limited using equity method as follows. There is a share of profit of 378 crores, share of exchange difference in OCI, 54 crores, share of revaluation reserve of PPE, 27 crores. And these are all examples of equity, right? Simply means whatever you invested originally, you're just going to add that as a part of your investment, okay? And by the way, this statement supports our view. It says that the carrying value of the investment on 31st of March 2018 was therefore 4320 plus 378 plus 54 plus 27, which is 4779 crores. Okay. The next day, on 1st of April 2018, Deepak Limited acquired remaining 75% of Sean Limited. The moment you see this, right? The moment you see this, it is specifically an example of step acquisition. Okay, what does it signify? It means that the control is established on 1st of April 2018. What do you do on that day? The moment the control is established, you consolidate. That's what you're supposed to remember. You consolidate, right? You calculate goodwill on that date. You take all the net assets of that other company, as a part of the group. That is something that you want to remember, right? Now it says that you acquired the 75% stake by paying 13,500 crores. The fair value of the interest that you already had is 4860 crores, right? And the fair value of identifiable net assets was 16,200 crores on that date. Okay, straightforward. The control is established on 1st of April 2018, calculate goodwill on that date. That's what you are supposed to do. That's what you want to remember at all times. Okay. Anyhow, the question's requirement is how should such business combination be accounted for in accordance with the applicable Ind AS? Now, the relevant Ind AS is 103. Ind AS 103, of course, which is business combinations. You are acquiring the business combination, or you are achieving the business combination on 1st of April 2018. Okay, so when I look at this statement, the straightforward question, it's an easy marks of 8 marks, right? It's an easy 8 marks for you if you know the concept already. Okay, we're saying that the control is established on 1st of April 2018. Accordingly, Deepak Limited will consolidate all assets and liabilities of Sean Limited starting 1st of April 2018. Okay. The purchase consideration including any original investments will be measured at fair value, right? Any difference between the purchase consideration and net assets shall be recognized as goodwill. Difference between what you're paying versus what you're getting is going to be a goodwill or a capital reserve, as the case may be, right? But what you're paying, you remember, you need to measure it at fair value. Okay, whatever you are getting, whatever you're going to consolidate, you measure that as well at the fair value on the date of acquisition, that is on the date of establishment of control. Okay, so let's do that together here. Okay, so what I want to do is, we are saying that I may say my working one, which is goodwill. I'm looking at purchase consideration, let's say for 75% stake, that is given to us at 13,500 crores. So let's call it rupees crores. Okay, for the 25% stake, we take it at fair value. You want to remember that, right? What is the fair value of that interest that you already had is 4860 crores. And this gives a total value of 18,360 crores. Okay, less net assets in Sean Limited, which is of course given at 16,200 crores. Okay, which simply means that my goodwill, I'm paying extra. So this difference will be considered as goodwill and of course reported like that. Okay, now this is one part of the conversation, right? We're also provided, of course, that there is a share of profit and then exchange differences and revaluation reserve, etc. So the carrying value of the investment is 4779. Okay, but we are accounting for that at 4860. What we are supposed to do in that case? All right, just take a step back. Here we go. What I was saying is the difference between the fair value and carrying amount of the, right? The difference between the fair value and the carrying amount of the original investment is considered as a gain or a loss, as the case may be. In this case, of course, the fair value is more than the carrying value, right? To be recognized in the income statement of Deepak Limited at consolidated level. Okay, at a group level, you recognize this profit. So the amount to be recognized will be 4860 minus 4779, right? So this 81 is the gain on disposal of initial shareholding. It's a gain on disposal of initial shareholding. Now we may argue we never sold this, but then that's the way we want to understand. The moment you establish control, you assume that whatever you had earlier has been taken off, has been practically disposed, and you reacquired the entire 100% stake in the given scenario, which means that this 81 becomes your realized profit there. Okay. Now, also importantly, there is an exchange gain, exchange difference gain of 54. So even this gain, exchange difference, right, recognized in the OCI will be transferred to income statement, right? Because it's practically a disposal of the initial, stake in that associate. Okay, so that becomes a realized profit. However, since we also have a gain on revaluation, right? The amount in the revaluation reserve does not get recycled and therefore is adjusted through retained earnings. So it's adjusted directly to retained earnings. Now, what does it mean, right? How do I bring this entire, transaction on the business combination through a journal entry? We are saying in the groups of the journal entry, in the consolidated financial statement will be to of course recognize this business combination. We have debit net assets, which is 16,200, right? We say debit goodwill that we calculated, which is 2160. So let's take that number, right? Debit exchange difference, which is OCI, which is 54. Debit revaluation reserve, which is also sitting in OCI, that is 27. And then we say credit purchase consideration, right, which is 13,500 crores, right? Credit investment in that associate, we already had 4,779. So we need to, of course, disregard that. We have to, of course, de-recognize that, right? Credit gain on disposal, which is 81 that we calculated, and finally gain recycled, which was in OCI 54, and credit, of course, retained earnings, which is, of course, 27. So that's how you start, considering this entire movement from an accounting perspective, right? So this is what you need to explain it to the examiner and suggest the accounting treatment. Normally, even if the examination is not suggesting you to write these journal entries, it is recommended. It is recommended to explain that with the help of, how does the accounting, come into the picture. Of course, the narration could be being step acquisition for Sean Limited accounted for, right? That's how you can, of course, explain the accounting treatment in the books of Deepak Limited at a group level. All right. Thank you very much.